everyone, to episode 43 of Top of Mind with Consilio Wealth. Hao and I are back today to discuss some fun stuff in the news. Today is February 27th. It's 11:16 in the morning Pacific. It's Tuesday. There's some ice on the ground here in Seattle. And I think it snowed actually like exactly a year ago. My phone reminded me of that this morning. Anyway, that's not what we're here to talk about. That's not here in the news. First thing we're going to talk about today, Lyft earnings typo. Did everybody see that? Lyft made a typo in their earnings, which caused their stock to spike and then fall. I can't believe that happened, but it happened. So we wanted to unpack that a little bit. NVDA earnings and AI. England and Japan fall into a technical recession. Did you know that 22% of market returns over the last 100 years came from 5 stocks? There's an interesting paper that we found that we wanted to unpack there. And finally, retail investors are incredibly bullish right now. If you think about a 0 to 120 miles an hour, it's like 119 miles an hour. Retail investors are incredibly bullish. Hao, welcome back to the pod. Great to see you. It's been a while.
Hey, Chris. Likewise, yeah. Great seeing you.
So let's start with Lyft. I can't even believe this. I was out last week on vacation and I totally missed this. So
yeah.
Tell us what happened.
Yeah, it's funny because I don't think me or you were personally involved, but it's pretty bad. Lyft had earnings, and just walk you through a timeline of what earnings looks like, right? So the company releases like a paper report, and then maybe 5 minutes later, they'll get on what's called an earnings call with all the analysts. The paper report in this day and age is really important because all these algorithm traders have, scannable programs that look through earnings for you and say, hey, this is a really great earnings. We need to buy. And keep in mind, Lyft reported at 1 o'clock Pacific, which, the market closes at 1 o'clock Pacific. And now we're in after hours trading. So Lyft's volume during that day, 12 million shares exchanged hands during market hours. After market, 47 million shares traded hands.
Whoa.
So the power of algorithmic trading, the power of being able to scan an earnings report. I don't know if you looked at earnings reports, like 100 pages long.
They're long,
right?
yeah.
There's no way you could get it through 5 minutes before, the CFO speaks, the CEO speaks. So what happened was the report was released with a pretty small typo, small on paper, big ramifications, right? And then 5 minutes later, they got on the call and said, first thing they said was, there's a typo in the earnings report. We published a 5% growth in our operating margins or gross margins, and it was supposed to be 0.05% growth. So 5 full percent versus 0.05%. They said it was a decimal error. It's quite a big error.
It was 0.5%, right?
Yeah, 0.5%.
Yeah, so 5% versus 0.5%.
Yeah.
Because they did it in basis points, right? 500 basis points versus 50.
Yeah. And basis points, for everyone's knowledge, is a bit of an insight, finance jargon for a decimal, right? Like 5 basis points is 0.05%. 50 basis points is 0.5%. So they do use basis points, and I think everyone glammed on it because a 5 percentage point, 500 basis point gross margin increase just suddenly made Lyft more valuable, rightfully so, right? One of the most valuable companies suddenly in the ride-sharing side. So when you get that, all these algorithms, alerted their traders to buy, and you're buying aftermarket. Even though the volume increased, the aftermarket liquidity isn't as strong as during the market, right? There's a reason why the market isn't open 24 hours a day because, if me and you were trading at 3 a.m., one of us is getting hosed because, there's no real market there. So even though there's an increased volume, I think the algorithms glammed onto that 500 basis points versus, 50 basis points difference, right? You're talking a 4.5 point difference in profitability. it bid up Lyft's stock 60%. And by the time, yeah, and this is all happening right when the call starts. So that by the time the CFO, the chief financial officer of Lyft, speaks and says, we flubbed, we misreported the gross margin line, the stock went from 60% up to about 12% up. So still,
So this all
pretty
happened
good.
in 5 minutes?
This all happened within minutes, yeah.
Wow.
And then by the next day, Lyft was up about 30%. But still, if you bought Lyft at 60% higher, which is roughly $19 a share at its peak, you're holding Lyft stock that's worth $15 a share. If you invested enough on it, 47 million trades is someone invested a lot, and someone lost a lot from that swing by a reporting error.
Mm-hmm. I mean, that's just crazy.
That's insane, right?
There's a quote here that says, it's a black eye moment that I haven't seen in almost 25 years in the street to make an error like this. That's wild. I mean, we have not heard the last of this, because you can just imagine. So executives will typically enroll in predetermined sale plans. They're called 10b5-1 plans. And that can be a sell at this date, sell at this price, sell this many shares at this price. And so you can imagine that these insiders had higher price targets on their shares, and that I'm sure those executed then at those higher price targets in those minutes of trading. I'm sure that's going to get clawed back, and should be.
Yeah.
Because the stock spiked based on an error. I mean, insider trading, the lawsuits are going to be silly with this.
Yeah, and anyone on the wrong side of the trade, right? Anyone who could trade on an instantaneous, earnings report probably has some horsepower behind them in terms of capital. So they probably have a team of lawyers that are chomping at the bit to claw some of these losses back from Lyft.
Jeez, that's wild. Imagine if you were the one that bought and then sold 60% up and went home for the day. And then it came crashing down, and because that trade's going to get clawed back too. You can't just have profits.
Yeah. Yeah, and that's the folly in aftermarkets trading. The wild west kind of opens up again for the stock market. So if you're going to do that, I would use limit orders or just avoid aftermarket trading, especially on earnings, because we gave an example of you're swimming with sharks. If you think you could be in an algorithm that can trade within seconds and scan a 100-page earnings document within seconds and trade on that, there's no way you have that computing power as a single trader. You're already lost, and I would not recommend anyone jump in the after hours market on earnings day, because you are swimming with sharks. You're going to lose.
Definitely.
Yeah.
Definitely. Wow. Well, we have not heard the last of that. We'll see when that comes back up.
Yeah, her next up is it's like, hey, class action lawsuit.
Hey, and class action lawsuit. Exactly. Jeez.
So if you lost, I'm sorry, but don't jump into the after hours trading like that. That's crazy.
Yeah. All right, let's cover NVIDIA earnings and AI. NVIDIA had a great earnings report. So
Great.
What happened here?
It's for real this time. I think NVIDIA, like every other Fortune 500 company, should be looking at the numbers that they're putting out there. And I think NVIDIA is in a string of quarterly beats, meaning they have really heightened expectations and they're somehow meeting them, right? Mm-hmm. So they have a backlog of orders still, specifically for GPUs or graphic processing units for AI. That backlog has been about a year. That backlog is still cut down to about 4 months. So they have a demand problem where they have too much demand, and they are improving their supply problem where they're meeting that demand, where they're cutting down lead times from 1 year to 4 months. So I think NVIDIA is still very much a high demand product, and because everyone wants to start building up their infrastructure for AI.
Is that you mentioned that they're able to deliver their chips faster now? Is that because their backlog is shortening, or is that because that they're able to process them faster? Maybe they've expanded more I know they partner with TSMC to build these things. So like what caused that shortening of delivery?
I think you bring up a great point. I think that from what I could tell from the articles that we do have, it looks like the demand is ebbing a little bit. So, you buy a graphics unit for AI, you don't need to buy a new one in 2 weeks. It's not a consumable, right? That cycles that fast.
Right.
And I think what could be seeing is, a bit of a slowdown because anyone who wants AI capabilities has probably already gotten AI capabilities in terms of storage, cloud computing, GPUs, things of that nature.
Yeah, I mean, if you think about it, if NVIDIA's accepting more orders than they can ship out, they're booking more revenue than they're booking costs too.
Exactly.
Now, I don't know how they do their terms but I don't know how the accounting works in there,
Sure.
but let's say for every 2 that I sell, I can only ship 1. I'm booking double the revenue. So in theory, as their supply chain catches up and they're just shipping new orders versus new orders and backlogs, they should have not necessarily a decline in revenue, but a decline in speed of growth of revenue.
Correct.
Because so that'll
Correct.
be interesting as, I don't know where that is, if that's happening, in a month or this year or next year or whatever, but that'll happen at some point.
Yeah. And I think the stock's shareholders have been rewarded for all that demand. The stock's up over 240% in the last year or so. I think there is at this point, it's still an insatiable appetite, but I think NVIDIA, no matter who wins the AI battle, NVIDIA is providing the picks and shovels, right? Like, remember the gold rush? The people who made the most money were the tool manufacturers, not the gold diggers. And I think this is what we're looking at with NVIDIA being such a poster child for AI is the chips are sold. They made all the money off of it, no matter who wins the AI battle.
Interesting.
So what I would be watching out for is we are seeing an uptick in the number of companies during the earnings reports mentioning AI. In the last quarter, 36% of the S&P 500 companies mentioned AI, up from 31% of the previous quarter. So we're seeing, similar to the crypto craze, everyone is trying to, shoehorn in AI into their business. I remember we talked about Kroger, like, oh yeah, we use AI for our supply grocery chain. It was like, well, everyone has and everyone does. Amazon has been using some form of AI for their distribution and their shopping suggestions, but you're seeing that being pushed forward to try to gin up the stock price.
Interesting. Yeah, it says so 80% of the company's index is pointing to AI. So there's a big increase in companies that are talking about this.
And I think
a
red flag. Remember that Long Island iced tea company? They changed their name to Long Blockchain Corp, and the stock was up 200%. So when you start seeing stuff like that, you probably should look at your holdings and see who's really just trying to get a short-term pop on their stock.
Well, and I think what we're going to see this year, there's this AI craze, right? And many stocks have been bid up because of the unknown of what the potential is. I think what we're going to see this year is kind of the reckoning of what it actually costs and what is the market appetite for it. The various tools that I've looked at, they really range in cost from a couple of dollars to kind of expensive, $150 a month, for example, for some of the things we're looking at the business level.
Yeah.
And so, these things can be on the expensive side and then also on the really cheap side. I think as AI started in a lot of these tools for, consumers, they're free, right? ChatGPT is free, log in. And I recognize that there's you can pay more money to get a faster and more updated system. My biggest question is the cost in building all this out has to be just insane. And
Correct.
Where is the market for applications at the price point. Like this isn't just going to become a service that's wrapped into your Office subscription. Office, for example, is adding a $30 a month extra AI charge for businesses to implement their Copilot. My question is that enough? Like, is there demand at $30 a month? Does $30 a month cover their cost? I mean, I suppose their models would suggest, well, at scale, everything covers their cost, but does it? I mean, remember how many years it took Amazon to turn a profit? Like forever. And so I think this year will kind of start to be the reckoning of both, are you being company, are you getting consumers to buy your product? And then B, what is it costing you to deliver that product? We just know that like the compute power to produce something on your screen on ChatGPT is incredibly expensive. And again, I think 2024 will be the year where we truly start to see winners and losers in that space, and finally kind of reveal who's actually making money at this and what the true cost of building out all these systems is.
And I think what you're describing is top line is like how much people are willing to pay for AI applications. But think about the Walmarts and the Krogers. How much more can they squeeze out in terms of efficiency by using AI? So that's a bottom line address, right? Because you're looking at reducing costs. I don't know how much a grocery store can, meaningfully improve their margins. Let's say it's 1 or 2%. Yes, as we saw with Lyft, a full percent is game changing. But is the upfront investment really going to pay off for these guys? I don't know. At least from what I'm seeing now. We do have a post on the Consilio site about this. It's like, what if AI is a dud? And I think Chris and I are looking at it from a cost benefit standpoint, right? Like, is it going to play out the way people think it is? I don't know. Expectations are really high, and the only beneficiaries are the ones providing the tools.
So far, yeah.
So far,
well, yeah. I was going to say Microsoft, but yeah, they're providing the tools in that sense.
Exactly.
I think you bring up a good point too, because there's a lot of efficiency gains that can be measured, and I think that'll start to reveal itself as well. And so, to be clear, we're not bearish on AI. It's really more of there's been a lot of run up in the markets for AI stocks. Our point of view is there's going to be some winners, there's going to be some losers, and those losers potentially spent a ton of money on something that isn't yielding the result that was hoped. Kind of like coming back to the metaverse conversation, right? When Meta was spending a ton of money on the metaverse and showing no revenue, and like, if you're spending billions and you're making millions, that's going to catch up to your stock price pretty fast. And then I think you're going to see dramatic changes in investment and pivots. It's like, where's Apple in all of this, right? Like, Apple hasn't announced anything regarding AI.
Yep.
Siri isn't that great, right? Siri hasn't really been. Yep. Okay, it's talking to me now.
Yeah, probably one of the most obvious. Yeah, probably one of the most obvious applications for AI is their current product, Siri. I don't get why they aren't pumping that up more. But Apple's been known to sandbag until they're ready.
Yeah.
So
and I mean, what are they going to come out with, right? Like, they build their own chips, right? So, but they're not going to sell those chips. They could come up with an AI-enabled chip in their iPhone, and they could, pivot that way, and that could cause the stock to jump. But and they're building out their services wing, right? But I don't foresee Apple having a Bard or a ChatGPT type thing. Like, it's just not there. They're just an incredibly focused company. So anyway, I'm curious on where they're at with all that, and hopefully they reveal something soon that would tell us all. Because to date, really haven't seen anything from them. Everybody else has said a bunch.
And as a result, their stock price has gotten left behind, right? The Magnificent Seven suddenly
has caught up. Yeah, it used to be Apple worth way more than everybody else, and then everybody else also worth a lot of money. Now it's like you've got these other companies that are bumping up against Apple, and in some cases with Microsoft, went above Apple for a short period of time. Yeah, exactly. Yeah. So this will be interesting to watch this year. I think we'll definitely see clear winners and losers. Maybe even a announcement from Apple, which I think will be interesting. All right, let's move over to England and Japan fall into a paper recession. Interesting. this wasn't widely covered. So cover this. Remind us all what is a technical definition of a recession, and then what's going on over there in England and Japan.
Yeah, all it means is recession. GDP is negative for 2 quarters in a row, so 6 months in a row of negative GDP growth.
Okay.
We actually hit that in 22, and people seem to forget that because 22 was a pretty bad year, and that officially wasn't a recession, but it was a paper recession. I think Chris and I talked about it ad nauseum when it did happen. This group of economists need to stamp it. So they haven't come out and said officially Japan or England is in a recession, because both stock markets are doing relatively well. They're actually positive on the year despite this news. So that's first and foremost the only definition of a paper recession is negative growth for 2 consecutive quarters. England's issue is they're running into some trade issues, right? They had Brexit, and they're still dealing with some of the subsidies that they, I don't know, suddenly forgot about when they wanted to exit the European Union. And they have to renegotiate some of those trade deals in terms of their import-export, right? Again, not to bore you, but a lot of people left the finance industry in England and went over to Belgium, right? And because in finance, you want the least amount of friction possible. Japan's case, they are seeing a big uptick in tourism, like people coming in from other countries because the yen is so weak. And on the flip side is despite all that, they have lower domestic spending, meaning the Japanese citizens are unwilling to spend. And I think even despite the uptick in tourism, they're seeing the natural population not really spending the way they should.
Do they still have negative interest rates in Japan?
They do, yeah. They are looking to swing those positive this year, but with the news of shrinking GDP, they're more likely going to keep the negative rate policy in effect for a while.
So for context there, so if you have negative interest rates, you have no incentive to leave any money in the bank.
Correct, you're losing money, yeah.
Yeah, so like in our world, right, we can make 5% on a high-yield savings account or 4% or whatever these days, right? You have incentive to leave money in the bank and spend less. Japan has the opposite problem, and they've had that for many, many years.
Decades, yeah.
Decades. That's what's sort of stimulated their economy. So it's interesting that you're saying even with that, people aren't spending. I wonder if money's in the bank or they're just not making it, or what's, that's interesting. But anyway, no spending. Interesting.
No spending. Despite that, Japan's economy is in line with the S&P performance. So the S&P's done well. People blinked.
In what time frame? This year?
In the last year, Japan's up 26%.
Wow.
Which is pretty wild to think about, because you always thought of Japan as this shrinking population and shrinking economy, right? And they've been keeping pace with the U.S. since 2023.
Interesting. Okay, so likely Japan keeps their current policies to try to jump out of recession, and then what about England, though? I mean, what's England's path out of this recession? I mean, this recession has been predicted forever, right? Did they hit a recession when the U.S. did?
Not officially.
Not officially. Okay, so this is the first one.
I think that's the case for making the case for a globally diversified portfolio, because one, you don't know when and if the U.S. is going to enter recession, but there's other countries that have booming manufacturing industries, things like that. England, a little bit more mixed, because I think they're more politically driven. I don't think the European Union has a lot of interest in helping them out and subsidizing more than they need to, because they're not part of the EU anymore. So England decided to go at it alone. I think they overestimated the amount of finance jobs they would keep. Like, these are high-paying jobs, right? At Barclays banks, big banks moved employees out of the country because it's just easier to operate in EU proper versus England. So they're running into a real estate issue. They're running into a trade and farming issue. Farmers are having problems getting what they think is fair market value for their crops, but no one outside of England is willing to pay what they used to pay, because all they did was shift their purchases to other parts of the union. So,
wow. Do you think they're
yeah.
going to un-Brexit? Are they going to like Rexit, fix it, rejoin it? Like, I mean, this is a big deal.
Yeah, and I think if you look at polling in England, they would say let's not Brexit. I don't think they're willing to
un-Brexit.
I don't think they're willing to unwind the damage that's been done the last 4 years, but meaning they would want to stay independent of European Union because I think the damage has been done. But the polling does say if we had a choice, would we have stayed or left? They would have overwhelmingly, like 70% said stay. But that's a problem with thinking. It's you don't get yesterday's price, right? You can tell every Englander that, well, you voted that way, so that's your problem to deal with going forward because you had such a pretty good trade situation with the European Union, and you just flushed it down the toilet.
Interesting. I think that's going to be many years in the making.
Decades, probably, yeah.
Decades, probably, yeah. Because you're right. You don't just exit and then rejoin, right? It's going to be a long time. Because first of all, you can't just exit and then immediately become self-sufficient. It takes many, many years. I mean, think about what the U.S. is trying to do with building their own chip factories and things like that. Takes decades to build out and spin up. And so, hopefully, they have a long-term plan there and they're executing on it. But if they don't, maybe it's 20 or 30 years down the road and then they actually rejoin. That's interesting.
Yeah. Good luck to them. But again, they shot themselves in the foot there.
As we say all the time when we're looking at market returns, very easy to look in the rear view mirror and describe what happened. Very hard to look out the windshield and predict what's going to happen. So,
it's always easier to think the grass is greener on the other side. Mm-hmm. And you find out that the grass is just painted grass and it's not real grass.
It's turf.
Yep. But yeah, good luck to them. Again, we invest globally, so hopefully they can turn around. It's just not very likely.
So our next thing here, I think our listeners will find this is interesting. So did you know that 22% of market returns over the last 100 years has come from 5 stocks? It's an interesting paper here that we came across from Hendrik Bessembinder, and he is a professor down at Arizona State University in Tempe. This paper is titled Wealth Creation in the U.S. Public Stock Markets from 1926 to 2019. And the report quantifies long-run stock market outcomes in terms of the increases or decreases relative to a T-bill benchmark in shareholder wealth. So the U.S. stock market investments on net increased about $50 trillion between 1926 and 2019. The largest share of that was everybody's favorite, tech firms. So technology firms accounted for the largest share at $9 trillion. But keep listening. But telecommunications, energy, and healthcare and pharmaceutical stocks created wealth disproportionate to the numbers of firms in the industry. So there was a lot of tech firms that created a lot of wealth, but from the pharmaceutical standpoint, energy, healthcare, fewer firms that created even more wealth per firm, if that makes sense. So the degree to which stock market wealth creation is concentrated in a few top performing firms has increased over time and was particularly strong particularly strong during the most recent 3 years, when 5 firms accounted for 22% of net wealth creation. I'm going to stop there. How I want your thoughts, and let's unpack this a little bit further. This is totally a conversation around concentration and diversification.
Yeah, and I think NVIDIA really sticks out. NVIDIA is not on this list. It is, just to spoil it, just going down the list.
I think this paper
was stopped in
2019, so yep. NVIDIA probably would be now.
Yeah, they probably would be, right? But let's go to the top 5. Apple, Microsoft, ExxonMobil, Amazon, and Alphabet. So 4 of the top 5 are technology-based companies. So how I would think about it is the economy, the pie has definitely grown. Mm-hmm. So in terms of absolute dollars, those recent winners make sense. What's going to be in next 20 years, right? What are the big wealth creators? I think the economy is obviously going to expand in 20 years. So what are the winners or the biggest wealth creators of the next 20 years going to be? It might not be tech, for all we know. It might be a car company that creates flying cars and everyone wants the flying car. Those are things that, with the expanding economy and how this report was measured was in absolute dollars, where you suddenly got $1 trillion companies. Imagine that in 1930. Right?
$2-3 trillion companies.
Yeah. So one, the size of the pie generally has grown, and two, I think you don't bet against the U.S. economy over long stretches like that, and three, another part of this report was about 40% of the companies in the stock market over 100 years. No, sorry, 60% of the companies in the stock market have actually lost money for investors. So you went boom or bust, more likely bust, and you still made money as an investor.
It's interesting here because this is totally a case, of the relative merits between broad diversification versus narrow portfolio selection. However, as you point out, the majority, and I'm reading from this article, the majority of individual stock investments led to decreased rather than increased wealth in the long run. Aggregate shareholder wealth creation is concentrated in a relatively few high-performing stocks. So it's really the double-double, right? You had to pick the right ones and then hold them a long time to get the big wins, which, again, rearview mirror. Of course it was that one.
Yeah.
But many of these on this list, wouldn't have been so obvious at the time. I think the point of this is if you were broadly diversified, if you bought, say, the index, you owned the small company when it was small, that then became the big company. You owned NVIDIA when it was tiny. You owned Amazon when it was tiny. You owned Google when it was tiny. And those then, catapulted to what they are today. Would you have made more if you were concentrated? Yeah. But you would have had to make that pick, so many years ago and get it right, which is on average very, very hard to do.
Yeah, we had a picture sent to us of a daughter cleaning out her mother's attic, and there's these old stock certificates, but unfortunately they were worthless, so the company's out of business. Can you name me a company that was in business in the 1980s heyday that's still around? Maybe a handful.
Cisco. Yeah. I don't know when Cisco was founded.
Well, when I think 80s, I think Blockbuster, I think Montgomery Ward, Mervyn's. I don't know. Sears.
I mean, yes, I was going to say Sears, Macy's. They're still around.
Macy's, yeah, they're fighting for their life.
They hit the news today. They've got a new strategy to sell a bunch of stores and revive. We'll see if they can do it.
So I think the odds of, it's always a nice story when you hear about uncovering stock certificates in the attic that have been forgotten and they're suddenly worth millions. Unfortunately, that's
I'm still looking for those. Yeah. Got to go up in the attic.
Especially in the new house. The construction worker just put some defunct companies' certificates in the attic.
You never know.
Yeah.
You never know.
But I think one, it's a massive data set going back 100 years and measuring company performance in absolute terms, to be fair, is pretty otherworldly, right? But I think what you'll see is the economy has compounded, right? Gotten more and more valuable as years goes on. Mm-hmm. I think you'll see new names take over. Like we mentioned with NVIDIA, I see Facebook on the list too. And Facebook's not a very old company in terms of stock market life. Is Facebook going to exist in 20 years? I don't know. Maybe. I would guess so. It really all depends, right, on regulation and what the market wants. So I think we will continue to see this list evolve because, one, I think we're going to see $1 trillion companies as a commonality versus rarity, right? Because for the longest time, it was just Apple. Now we're seeing
Yep.
it Microsoft, NVIDIA, Meta,
Amazon's over $1 trillion.
Amazon, is
Google.
Google.
Yep.
Yeah. Berkshire Hathaway just hit $1 trillion over the weekend. I think it's getting more and more common because the pie is growing, right? And the last episode we were saying how uncommon it was for the market not to create new highs in such a long time, right? This is only 7th time in history where when the market created a new high, we had to wait more than 2 years.
Mm-hmm.
So it's the economy is always expanding. So I think if you get new and newer companies that are, pushing new industry, I think you'll see these new winners that have suddenly created wealth. But I would take that with a big grain of salt because the next winner would seem so obvious only after the fact. I think
what I get from this, so over 100 years, it's 22%, or it's 5 stocks that accounted for 22% of wealth creation, and that's most particularly over the last 3 years, which of course we've all lived. But owning the broad basket of stocks gives you the highest ability to own the 5 that are good. Like, I think that's the point of the paper, is like when you're broadly diversified, you have a high chance of winning and owning those 5 that have done really well. But you need to own those 5 because if you didn't, you missed out on a lot of wealth creation. I think that's, to me, kind of the knock on like the equal weight type things. We see that sometimes clients will buy like an equal weight S&P. And the problem with that is that it is equally weighting all of the holdings. So it doesn't actually allow for the smaller holdings to become bigger holdings.
Yeah.
The S&P is a market cap weighted index, so bigger companies get a bigger weight. Of course, that can be risky when things come down, particularly if it's those bigger companies. But that's the whole point, is that diversification across the index and allowing the small to become big and owning them for that whole time. That's the kind of point I get from this paper. Obviously, what it wants to scratch is like, okay, tell me the formula. How do we pick stocks that can just win and get the 5? But of course, there isn't a clear, well-defined process to pick those stocks on a consistent basis and win every time.
Yeah, well, the paper says it. You have more chance of losing money by stock picking 60% of the time, right?
Yeah.
Than making money. And then taking another level is making wealth created money like the Apples and the Microsofts, right? Where you're not only winning, but you're winning to the extent where you're generating real wealth, right? Because I could pick Johnson & Johnson, for example, and I've done pretty average. I didn't lose money, but I didn't make NVIDIA type money. And that's what makes stock picking hard. And I think that's always puts up your company stock for review, right? Like, how much of my Enron stock did I own? 50%? All right, Enron was the best company in the late 90s.
Mm-hmm.
And I think that is, one, diversify your core investments, and you have your play money, I get it, but the paper does cite like there is a need, and they think it's rational to try to get those home runs, right? To win those lottery picks.
I mean, to round this out, your next stock behind Google Alphabet is J&J. It's Johnson & Johnson, Walmart, IBM,
Yeah.
Berkshire, Procter & Gamble, Altria, and then good old GE.
Yeah.
General Electric is on this list. Again, this ends in 2019, so a couple of years of stale data, but still, that created all the way down. If you had down to GM, maybe we'll even throw Chase in there. So JP Morgan. That's the 20% of wealth creation right there over the last 100 years. Interesting.
Yeah, AT&T is on that list. Would you want to own AT&T as a bet in the future? Probably not.
Right, but if you owned it as a tiny and now a big, you did okay.
Exactly.
You did extremely well.
Exactly.
Yeah. Okay, let's shift to our last topic as we wrap up today. So retail investors are incredibly bullish right now, as judged by trading and by option markets signaling. There's kind of some interesting things. There's like the fear greed index, which I think is built on options. So I want you to just unpack this a little bit as we wrap up here. What's going on with bullishness and retail investors?
Yeah, I guess despite all the data that we do put out, people still think that holding, 40% NVIDIA is great. And yes, I think holding the concentration makes millionaires, right? It's the issue of staying a millionaire. So yeah, Schwab and TD did a sentiment survey, and about 53% of the respondents suddenly had a bullish view of the stock market. And that's an issue because the fear greed index has swung to extreme greed. So we're talking, going 100 miles an hour on the freeway, and we're above the max limit in terms of valuation. And again, we've argued that fundamental valuation isn't a timing thing, so this can stay expensive for the foreseeable future. But I think I think by that, retail investors are kind of living up to the moniker of dumb money. It should have been the opposite, right? Everyone should have been greedy when we told them in 2022, and more sensible now. But it's working in opposite.
Is that fear greed index measures options activity? Is that right?
It measures where the flows are going. So it measures how much money is going to stocks versus bonds. How much, and the types of stocks and bonds. Yeah. So we do have data from Goldman saying retail flows are coming out of the S&P and the NASDAQ QQQ in significant levels since February 5th. So 22 days. And it looks like it's going into single names and options. So we're seeing an imbalance in options purchasing to the upside. So people are not only greedy, but they're levering up.
They're concentrating more. They're doing the opposite of the paper that we just talked about, right? So they're
doing the opposite.
They're selling their indexes and they're going further into these single stock names. Interesting. Wow. Yeah, it says that the bets on AI and AI related stocks have increased. It doesn't say by how much, but it says largely bullish on those stocks in the next 3 months. Interesting.
Yeah, and anyone who invested in NVIDIA in the last 3 months is probably shoved in our face. Oh, look how great I'm doing in the last 3 months.
Hey, still done well. Yeah. Yeah.
But investing isn't a 3-month activity. It's a lifetime activity. So is it sustainable? That's what I would ask with all the stuff that we brought up today is all that performance really in line with reality? Maybe. Most likely not. Yeah,
we're still looking out the windshield, rear view mirror, we'll know.
Yeah. So I think what we're seeing though is the purchasing of options to the upside in a pretty crowded trade from what I see on the charts. Is and single stock picks, and again the track record for 100-year stock market history is not very good, right, in terms of single stocks. So I would be cautious here, and bit of Warren Buffett going on, where being a little fearful when others are being greedy. And again, that I don't think that's us saying sell everything and watch on the sidelines. It's just I would start scaling and start rebalancing probably.
Yeah, we're saying stay and get diversified. That's what we're saying.
Yes. Buy England stocks, buy European stocks, right?
We're not saying individual thing. Exactly. Yeah. Keep in your portfolio, keep a level head.
Yeah, and I probably wouldn't, flash my Robinhood account with my one NVIDIA share that's up 240% and bragging about it. It just doesn't sustain.
Man, I wish I had that.
One stock of NVIDIA. Oh, again, I'm describing more of the GameStop retail investor who I know we've railed against the term dumb money. We think retail investors are really smart, but there are times when they overdo it themselves.
Sure. Yeah, we'll see. I don't know how often Schwab does this survey, the Trader Sentiment Survey. One thing I want to add there. So they said 53% of respondents were bullish. That was a jump from fourth quarter. So they must do this at least quarterly. Jump from 32% in the fourth quarter. So 32 to 53% quarter over quarter jump.
That's after the fact, right? The fourth quarter was
Well, but
You should
remember
be-
the beginning of the fourth quarter, it was like Halloween was basically where the market bottomed.
Yeah.
So people were, I'm surprised a third of people, I mean, that third was right. That third should have bought. Maybe they did.
Yeah.
You almost could have bought anything back there, and it did fine.
Yeah.
All right, this was fun. That's all the time we have today. Thanks everyone for tuning in to episode 43. We'll catch you again in 2 weeks.
All right.
Talk
Thanks,
soon.
Chris.